Ready to dig in.
Let's do it.
Today, we're going deep into ExxonMobil, specifically their 2024 annual report that's the Form 10K.
Right, the big one they file with the SEC. It's always a comprehensive look.
Exactly. And for anyone not familiar, this isn't just some, dusty financial filing.
No, definitely not. It's packed with details.
It shows us exactly how one of the world's biggest energy players is navigating, everything. Global markets, the energy transition.
All big challenges.
Our goal here is to pull out the most vital takeaways, give you that quick, informed overview.
Yeah, cut through the noise a bit.
Get set for some interesting facts and hopefully a few aha moments.
That's good.
All right, let's start at the top. When we talk about ExxonMobil, we're talking about a true global behemoth, right?
Absolutely. Colossal scale.
The report reminds us the company was incorporated way back 1882 in New Jersey.
A long history there.
But what struck you about their sheer scale and global footprint today, particularly, their workforce?
It's impressive, isn't it? Their reach is worldwide, operating, marketing products basically everywhere. And that point about employees over 60% from outside the U.S.
Wow, 60%.
Yeah, representing 160 different nationalities. It really underscores their focus on diversity. And they mention a meritocracy approach.
Interesting.
What's also clear is how they describe their business now. It's certainly not just about traditional oil and gas anymore.
Right. So beyond oil and gas, what new frontiers are they, actively exploring? What does the report say?
Well, they explicitly state they're pursuing lower emission and other new business opportunities.
Okay.
So beyond the usual exploration, production, selling petroleum products, they're actively investing in things like carbon capture and storage, CCS, hydrogen, lower emission fuels, even their own tech like Proxima systems.
Proxima, what's that exactly?
Basically advanced carbon conversion processes is my understanding, plus carbon materials and lithium.
Lithium too, okay.
Yeah, it clearly signals a diversified approach to future energy, trying different avenues.
And speaking of new, the report highlights that truly massive strategic move, the Pioneer Natural Resources acquisition in 2024.
Oh, yeah. That was huge.
Huge number, $63 billion in stock, another $5 billion in debt assumed. But what does it fundamentally signal about their long-term strategy, especially, in this shifting energy world?
Well, it fundamentally reshaped their portfolio. The report actually uses the word transforms.
Transforms, okay.
It says it creates an industry-leading, high-quality U.S. unconventional inventory position.
So more U.S. focus.
Especially bolstering their presence in the Permian Basin, which is, a very prolific, low-cost area.
Right, the Permian.
So it's not just about adding barrels, it's about adding high-return, lower-cost production.
Yeah.
It really indicates a strong commitment to that, even while they explore the new stuff.
Okay, so a mix of old and new, strategically.
Seems that way.
As we've seen, ExxonMobil operates on this immense scale, ambitious plans. But every venture, no matter how big, faces headwinds, right?
Always. Risks are everywhere.
What are some of the key risks and external forces their 10K highlights as, critical for their future?
It's actually kind of eye-opening how many risk factors they list as not really within their direct control.
Oh, interesting. Like what?
Well, big picture economic conditions, for one. Demand for energy, petrochemicals, it's all tied tightly to global prosperity.
Makes sense.
So they're vulnerable to downturns, recessions, trade tariffs, currency swings. They even mention de-dollarization in global trade as a potential risk.
Wow, de-dollarization, okay.
Yeah, and other demand factors too, like tech improvements in energy efficiency, renewables getting more competitive.
Like wind and solar.
Exactly. Wind, solar, nuclear, better energy storage, shifts in what consumers want. Think electric vehicles or alternatives to plastic.
And supply side risks.
Yep. Things like OPEC or OPEC plus quotas, wars, natural disasters, logistical logjams, anything that disrupts supply chains.
So beyond those market forces, how much do governments and global politics really influence things? What specific political or governmental risks pop up in the report?
Quite a bit, actually. The report talks about access limitations, meaning countries restricting access to oil and gas resources or maybe limiting foreign investment.
Okay.
It also highlights the lack of legal certainty in some places. Countries with, say, underdeveloped legal systems or constantly changing regulations makes it really hard to enforce contracts.
Right, that adds a whole layer of complexity.
Definitely underscores the geopolitical challenges they face operating globally.
And then there are the more direct regulatory and legal challenges. What does the report say about potential penalties or, lawsuits.
Yeah, it explicitly mentions regulatory and litigation risks.
Such as?
Potential tax hikes may be punitive taxes, like windfall profit taxes, price controls, new environmental rules that could penalize them for past stuff, or even make future business harder, including for the new ventures, like CCS.
Even for the new stuff.
Yeah. And the document specifically addresses ongoing legal proceedings. It notes how state, local governments, even private plaintiffs are using the legal system
To do what?
to, quote, promote public policy agendas, including trying to reduce hydrocarbon production through litigation against ExxonMobil or others in the industry.
So using lawsuits as a policy tool.
That's how the report frames it. And they give specific examples of penalties.
Oh, really?
Yeah, like a $4 million penalty for XTO Energy in Pennsylvania, $8 million for XTO in Ohio after a well blowout.
XTO is their subsidiary, right?
Correct. And a $14.25 million penalty for alleged Clean Air Act violations at their Baytown complex.
Are they fighting those?
It says they're still evaluating options to appeal, potentially even going to the U.S. Supreme Court for the Baytown case.
Wow, okay. And finally, on the risk front, what about security concerns? The physical and digital threats.
Yep, that's in there too. Civil unrest, sabotage, piracy, terrorism, cybersecurity attacks.
The usual suspects for a global company, I suppose.
Pretty much. All things that can drive up security costs or even shut down operations. Significant challenges.
So physical and digital security are constant battles. But maybe the most profound long-term challenge and the biggest conversation is navigating climate change and the energy transition.
Absolutely, that's central.
What does this 10K tell us about their approach here? How are they framing it?
Well, the report makes it clear that hitting society's net zero goals needs huge technological and infrastructure advances.
Okay, acknowledging the scale.
Right. And ExxonMobil explicitly states its objective to play a leading role in the energy transition.
A leading role. What does that look like in terms of targets?
Their announced ambition is net zero for Scope 1 and 2 emissions from their operated assets by 2050.
Scope 1 and 2. Can you quickly remind us what those are?
Sure. Scope 1 is direct emissions from their own operations. Think refineries, drilling sites. Scope 2 is indirect emissions from the energy they buy, like electricity to run their facilities.
Got it. So net zero Scope 1 and 2 by 2050. Any nearer-term goals?
Yes. They aim for net zero in their heritage Permian unconventional assets by 2030.
Heritage Permian.
Meaning the assets they had before the Pioneer acquisition. For the Pioneer assets, the target is 2035.
Okay, staggered targets there.
And they also plan for near-zero methane emissions and eliminating routine flaring, aligning with the World Bank's initiative.
Zero routine flaring. Okay. So how are they planning to tackle this technologically? And does the report hint at any challenges?
It emphasizes key lower carbon solutions: carbon capture and storage, hydrogen fuels, lower emission fuels.
CCS, hydrogen?
Oh,
The usual suspects in these discussions.
pretty much. They give an example. The Strathcona Renewable Diesel Project in Canada, expected startup in 2025.
What's the goal there?
To produce about 20,000 barrels of renewable diesel a day using low-carbon hydrogen and local feedstocks.
Yeah, a concrete project.
Yeah.
But does the report acknowledge the difficulty?
Well, it doesn't explicitly say, this is hard, but by highlighting the need for these technologies and significant infrastructure, it implicitly acknowledges that achieving net zero on a grand scale depends on broad technological progress and build-out, which isn't just up to them.
Right, it requires a whole ecosystem change.
Exactly.
This brings us to their long-term strategy then. What's the broader energy outlook that seems to underpin their decisions for the next few decades?
Their global outlook research is key here. It's foundational to their planning.
And what does that outlook project?
Well, it projects overall energy demand for transportation actually increasing by about 25% between 2023 and 2050.
Increasing, even with EVs.
Yes, but here's the nuance. Demand for liquid fuels for light-duty vehicles, cars, basically is expected to peak around 2025.
Yeah, okay. Peak soon.
And then decline significantly by 2050. That's because of better fuel economy and lots more electric cars, especially in China, Europe, and the U.S.
But commercial transport, trucks, ships, planes.
The outlook expects nearly all of those fleets will still run on liquid fuels, including biofuels, through 2050.
Interesting. What about industry?
Industry uses almost half the world's energy now, and as the global middle class grows, demand for durable goods rises.
Meaning more plastics, chemicals.
Exactly. So oil demand as a feedstock for industry is projected to keep growing.
And natural gas.
Global demand expected to rise over 20% by 2050, about 3/4 of that increase coming from Asia Pacific. LNG trade expected to grow significantly too.
Okay, so a very mixed picture depending on the sector and fuel type.
Definitely. Not a simple transition.
So, looking at these long-term projections, does the report suggest they still need to invest heavily in traditional oil and gas, or are they signaling a rapid phase-out? What's the takeaway on hydrocarbons?
This is where it gets really eye-opening, I think. The report frames the fundamental reality of oil production decline.
How so?
Their global outlook projects a natural decline rate for existing oil production of about 15% per year. 15%.
Just from existing wells drying up.
Basically, yes. And what that means, they project, is that without continued massive investment, by 2030, global supplies could fall from 100 million barrels a day down to less than 30 million.
Whoa, that's a huge drop.
It's a more than 70 million barrel per day shortfall from what the world is projected to need. It's a powerful way to frame why companies, even those aiming for lower emissions, argue they can't just stop investing in traditional resources overnight.
Or risk a massive energy crisis.
That's the implication. It really highlights the tension between energy security today and the transition tomorrow.
So the bottom line is,
the report underscores the need for significant ongoing investments just to maintain, let alone grow, the world's oil and gas supply, even in aggressive decarbonization scenarios.
okay, that's a stark perspective. Let's shift now to the nuts and bolts of their actual operations and financial performance. What about their proved reserves? What does that tell us?
Proved reserves are a key metric, yeah. At the end of 2024, they reported 19.9 billion oil equivalent barrels. GOEB.
Almost 20 billion barrels. How much of that is ready to produce?
About 37% is classified as proved undeveloped, meaning it's confirmed but not yet tapped with wells and infrastructure.
Okay.
They moved about 1.1 billion barrels from undeveloped to developed status in 2024, mostly from the U.S., Guyana, Kazakhstan, UAE.
And do they add new reserves?
Yep. Added about 2.3 billion barrels of proved undeveloped reserves, some through purchases like 0.4 GOEB in the U.S.,
Likely tied to Pioneer.
possibly, or other deals, and 1.9 GOEB through extensions and discoveries, mainly U.S. and Guyana again.
How reliable are these estimates?
Well, the report emphasizes their rigorous technical evaluations and detailed analysis, says it involves senior geoscientists, engineers, final approval from senior management.
And importantly,
They state the company doesn't tie compensation to specific quantitative reserve targets.
trying to avoid perverse incentives.
Seems like it. An interesting detail on ensuring objectivity.
Okay. Speaking of operations, their global footprint is just enormous. Where are some key areas they highlight?
Well, in the U.S., they held almost 10 million net acres at year-end 2024. Lots of development in the Permian, especially, as we said, boosted by Pioneer.
And outside the U.S., Guyana seems big.
Huge. 4.6 million net offshore acres there. Development ongoing on the Yellowtail and Uaru projects. The Whiptail project got funded in 2024, too.
A lot of activity. Anywhere else significant?
Kearl oil sands in Canada, they hold almost 70% of imperial oil. Major LNG operations in Qatar, Mozambique, and then operations scattered across Europe, Africa, Asia.
And they have commitments to deliver product, right?
Yes, contractually committed to deliver about 123 million barrels of oil and 2.8 trillion cubic feet of gas between 2025 and 2027. They expect to meet most of that from proved developed reserves.
Okay, that's a serious operational picture. What about their overall financial health? Any key indicators?
Well, one key measure is return on average capital employed, ROCE.
How's that looking?
It was 12.7% in 2024, which is noticeably down from 15% in 2023 and almost 25% back in 2020.
Oh, lower returns on their capital recently.
Yeah, signaling some shifts in capital productivity in what is, a very capital-intensive business.
And their spending plans, capital expenditures.
Cash CapEx was $25.6 billion in 2024. They plan to invest between $27 and $29 billion in 2025.
Stepping it up slightly.
Seems so. They already have $8.1 billion in firm commitments for 2025 and another $10 billion lined up for 2026 and beyond. So yeah, a very active investment pipeline.
Shifting gears just slightly. Beyond those legal penalties we talked about earlier, what's the broader financial commitment they're making to environmental protection and remediation? How much are they spending globally?
Their worldwide environmental spending for prevention and cleanup totaled $9 billion in 2024.
$9 billion. Wow.
And they expect that to increase to around $12 billion annually in 2025 and 2026.
$12 billion a year. Where does that money go?
Capital expenditures make up about 55% of that total. So investing in cleaner facilities, remediation tech, things like that, it's a substantial chunk of change allocated to managing their footprint.
Definitely. Okay, let's peek inside the company now. Culture, internal management, starting with cybersecurity. How are they protecting themselves digitally?
Their program seems pretty robust based on the report. It's integrated into their overall risk management.
Who oversees it?
The audit committee has oversight, including annual reviews. They use a multi-layered tech approach based on standard frameworks like the NIST Cybersecurity framework,
And the human element?
annual awareness training, regular drills to test preparedness, and they bring in independent third-party experts for testing and advice.
Have they had major breaches?
As of the report date, they said they hadn't identified any risks from known cyber threats that have materially affected operations or finances, which, for a company their size, is definitely good news.
Yeah, that's a constant target, I imagine. Now, beyond the sheer number of employees, what about incentives? How do they keep people, especially leaders, aligned?
The report mentions their incentive program granting restricted stock and restricted stock units, RSUs.
How does that work? Vesting periods?
For many employees, half the awards vest after 3 years, the other half after 7 years.
7 years, that's long.
It is. Different schedules for some senior execs, but it clearly indicates a long-term play for retention. It's not about quick gains.
Ties employee interests to the company's long-term performance.
Exactly. And interestingly, the RSUs for the Pioneer employees they acquired, those were converted to ExxonMobil RSUs vesting over 3 years. Helps integrate them.
That makes sense.
Mhm.
And speaking of financial interests and rules, the report also details their insider trading policy. What jumps out there?
Yeah, it's quite detailed, applies to everyone, directors, officers, employees, not just common sense, it's spelled out.
Key prohibitions.
Strictly prohibits trading securities based on material non-public information.
How do they define material and non-public?
Material is info a reasonable investor would consider important. Non-public is anything not properly out in the marketplace, like through an SEC filing or official webcast. Importantly, not just rumors or speculation in the press.
Okay, clear definitions. Any specific restrictions?
Yes, for covered persons, directors, exec officers, household members, there are mandatory blackout periods.
When are those?
They start before the 20th day of the last month of each quarter and end after earnings are announced.
And during blackouts?
Most open market trades, short sales, pledging stock are banned, though regular savings plan contributions and dividend reinvestment are usually okay.
What happens if you break the rules?
Severe penalties, both legal and company ones, including potentially losing your job. They take it very seriously, clearly aiming to maintain market integrity.
Okay, a lot to unpack there. So wrapping this up, what does this all mean for you, the listener? We've journeyed through ExxonMobil's world via this 10K. Global operations, big acquisitions, risk management, the push into lower emissions.
Right. We've seen how they're grappling with volatile markets, political shifts, that whole evolving energy landscape, all while managing this huge global presence and keeping tight internal controls.
It feels like a balancing act.
Stepping back, yeah, a company this size is almost a microcosm of broader global challenges and opportunities, isn't it?
Good point.
Their decisions, which you see laid bare in documents like this, really reflect that complex dance between today's energy demands, tomorrow's tech, and society's goals for a lower carbon future. It truly illustrates the tightrope they're walking.
So as you go about your day, maybe consider this. How do companies like ExxonMobil, with their immense scale, their deeply embedded infrastructure, how do they truly balance that imperative of meeting the world's growing energy needs with the urgent call for decarbonization?
Yeah, it's the central question.
And what role do you believe stable policy, those needed tech breakthroughs, and yes, continued investment, what role will they play in actually achieving that delicate balance in the years ahead?
Definitely gives us a lot to think about.
It certainly does.